It's telling me that gold and silver are finally beginning to slowly find real price discovery, which they've never been allowed to find, ever. Going all the way back to the London gold pool. Never found price discovery. It's starting to happen because delivery is overwhelming the ability to suppress with paper. That's just the bottom line. I think that's not true. I think that short-term caution should always be employed in a market that's moved up this fast. Long-term bullishness can coexist with that. And again, what I think even people like Ross, who far be it from me to argue with a man who's had serial success like him, but I believe this is different. This is not technical analysis. This is not what used to be. The dollar was always the beacon of trust, and the dollar isn't trusted anymore, nor are our institutions, nor is the system trusted. And I think gold and silver are reflecting that through delivery. The biggest, most well-informed players in the world continue to stand for delivery at a level no one has ever seen. And the retail public wouldn't know a gold coin if it fell on their foot. So no, this is far from a bubble. If this room was filled with people that have never been to a place like this, ever, then I might agree with that the retail public has no idea yet. I mean, there's more people here for sure.
Yeah.
But this isn't mainstream, dude. I mean, I've been doing this for so long, and I live in a country club of very well-heeled people, and maybe 5 or 6 of them have bought gold and silver from me. I don't talk about it. They know what I do. But there are very, very, very successful, wealthy people that are just, who believe what Ross is, that this is oversold, or overbought rather. This is a bubble. Look at the technicals. And I would say none of that matters in an environment that was once manipulated and is now trying to break free from that, because the most well-informed traders in the world disagree. And I think the public hasn't caught on yet. So no, I think we're a long ways away. But a correction, sure, doesn't change my long-term bullishness view. On the highest level, in December, we saw 65 million ounces or so delivered off the COMEX or onto the COMEX. Who's buying that? A mint box of Silver Eagles is 500 ounces, weighs 42 pounds. Who's buying 65 million ounces? But it's been between 40 and 60 plus million ounces every darn month for the last 15, 16 months. Who's doing that? And, you look at the LBMA, David Jensen, one of the best that there is, he says that London has 2 billion ounces in outstanding spot contracts that have standing behind it 140 million ounces. What could possibly go wrong if everyone stands for delivery? 2 billion into a window of 140 million. That's a problem. But when you look at what's happening here in the United States on a retail market, it's very, very, very confusing market. Largely because the price is moving up so fast the cost of maintaining positions is moving up so fast. Let me put it this way. We hedge every ounce we have. We will typically have between 2 and 3 million ounces of silver in our warehouse. To hedge one 5,000 ounce silver COMEX contract, you need to have over $40,000 in your margin account. On Christmas Day, it was 21,000. And so not only are the margin rates going higher, which shakes the weak hands off the tree. Let's look at December. They raised it twice in 2 weeks, before and after Christmas. So the day Christmas, 21,000, the next day, 27,000 in your margin account. Now it's over 40. But if you are someone with a bunch of money in your margin account and you have a bunch of contracts, you're trying to take advantage of the silver run, and all of a sudden they raise the margins on you by 30% on the day after Christmas, and if you don't pay, we liquidate. Well, a lot of people are forced to liquidate to cover their margin on the other contracts or whatnot, which selling begets selling. Now in 2011, that killed the rally. That's what they did to stop the rally. They raised margin a bunch. This time, what happens? Oh, it's the largest delivery in the history of the COMEX for the December contract, because the people that are standing for delivery, Kai, they don't use margin. They don't care. It's a subsidy to them. Thank you very much, they say. Scoop it up and stand for delivery. So things are changing, but I will tell you, like refineries, they're not taking any business right now because it's taking them so long to purify and produce, and they have to hedge their position too. So if they have 30 million in work, it takes weeks to get it fully produced from scrap or junk silver or doré or whatever to the refined product. It takes a while, but the price is moving up so fast that their hedge book, so if you have 30 million, you have to sell 30 million on COMEX. So if the price of your 30 million in inventory drops by, $10, you're not out enough to put you out of business. So instead, you short the exact same amount. You remain market neutral. Problem is, silver's moving up so fast and the rate hikes are moving up that they're getting margin called. So the refiners aren't taking anything. The big companies like myself and even the bigger ones who try to hedge, if you have 3 million ounces and it costs $41,000 to hedge 5,000 ounces, you have to have millions and millions and millions of dollars in your margin account just to maintain a hedge position. It's a crazy environment right now. Kai, I've never seen anything like it, but to me, all I look at is the most well-informed traders. Since I started talking with you, it was the central banks, and now it's progressed to whoever the hell is doing it here in the United States at a level no one's ever seen before. It does. Well, look what the U.S. government did. After all of these imports, what do? Oh, that's right. Silver's a critical mineral. Oh, that's right. We are now putting a floor underneath it. Within the next 90 days, a state-sponsored floor underneath all the critical minerals. Why? To incentivize domestic mining. If silver is found in a form called epithermal, like your skin is epidermis near the top, big deposits were found forever ago. So you got to dig further. Most of it comes from byproduct of copper, lead, and zinc. You got to dig further, look more. Well, the all-in sustaining cost at that level is probably $40. So if you put a price floor high enough underneath it, you will incentivize domestic mining. And now they just came out and are proposing a strategic stockpile. So you can see these things are happening, but the thing is that the mainstream doesn't get this, doesn't talk about it. You got to listen to people, conspiracy theorists like you and I, right? Or are we? But really, to me, what it is, instead of the world burning, it's the dollar bills that we call money are burning. The paper currencies have the sustaining power of a melting ice cube. And so did gold and silver really go higher, or did the dollar that we call money really fall further? And I think that's what it is. When you're creating $1 trillion in debt every 100 days, and 1 trillion seconds ago was 31,688 years ago, when the world no longer trusts dollars, no longer trusts treasuries, no longer trusts our institutions, judicial system, electoral system, immigration system, all of these systems, then what is the incentive to hold treasuries and or to hold dollars? There's not. And that's why we're seeing de-dollarization. That's why we're seeing commodities usurping treasuries. That's why we're seeing the dollar lose purchasing power. The world is always burning somewhere, but not to the way that people would frame it at $5,000 gold or $100 silver.
What's happening right now is something I've waited my entire career to see. And frankly, something I wasn't sure I'd see with my own eyes. For the first time in modern financial history, gold and silver are beginning to slip out of the grasp of the paper system that has suffocated them for half a century. People throw around the phrase price discovery like it's some harmless academic concept. No. Real price discovery in a suppressed market is not gentle. It's not orderly. It's not comfortable. When price discovery finally shows up, after decades of artificial ceilings and synthetic supply, it tends to show up with a sledgehammer. And that sledgehammer is starting to hit right now. You can go all the way back to the London gold pool in the 60s. Gold and silver have never been allowed to trade freely. Ever. These metals have been politically sensitive since the day central banks realized their power depended on controlling the monetary narrative. And so for decades, the system has thrown paper at the problem. Leverage it, hedge it, extend it, pretend it. You can do that until you can't. And the moment you can't, delivery becomes the only truth left in the room. That's what we're seeing now. Delivery overwhelming suppression. Physical demand overwhelming synthetic supply. The paper market finally colliding with the real world and losing. And look, I get it. People like Ross Beatty, who I respect immensely, have made fortunes reading cycles, charts, consolidations, pullbacks, technical signals. And under a normal market regime, they're right. Under normal circumstances, you apply classical technical analysis and you treat gold and silver like any other asset class with predictable waves of euphoria and exhaustion. But my argument, and what I've been screaming since last year, is that this time is not normal. This isn't 2011. This isn't even 1980. This is a period where trust in the entire Western financial architecture is fraying faster than the policymakers can patch over the holes. I don't think people fully grasp what it means when the world no longer trusts the dollar, what it means when the world no longer trusts our institutions, the judicial, the electoral, the intelligence systems, the economic data, the fiscal policy, the political leadership. The dollar has always been the beacon of global trust, and when that beacon dims, the world doesn't politely wait to see if the bulb gets replaced. They flee. Gold and silver are simply reflecting that loss of trust. And how do we know? Not through price. Price is still manipulated. We know through delivery, the movement of real metal from one set of hands to another. The biggest, most well-informed, deep-pocketed players in the world are standing for delivery in size we have never seen. Not in 2008, not in 2011, not during the oil shocks, not during COVID. Never. The retail public? Completely asleep. The average person wouldn't recognize a gold coin if it fell on their foot. They don't know what a bar of silver even weighs. They don't know what COMEX is. They don't know what backwardation means. That's why anyone calling this a bubble needs to check their definitions. A bubble requires retail mania. A bubble requires euphoria. A bubble requires people mortgaging their homes to buy silver. Instead, we're at maybe 1% public participation. If this room, right now, is considered a crowd, then the mainstream has absolutely no clue what's happening. And the funny thing? Even among extremely wealthy people, country club bankers, surgeons, executives, tech founders, almost none of them own real metal. They all own paper claims, ETFs, derivatives, mining shares, maybe a little. But very few actually hold physical gold or silver, and fewer still understand that holding SLV does not mean you own silver. That's like thinking you own Lake Tahoe because you printed a picture of it. But let's shift to the data, the stuff that really matters. December. Over 65 million ounces of silver delivered on COMEX. Let me repeat that. 65 million ounces. A mint box of 500 silver eagles weighs 42 pounds. So who, exactly, is taking delivery of 65 million ounces? Who is ordering the equivalent of 2.7 million pounds of silver? And then January hits, a non-delivery month, and within the first 6 days, we already see 33 million ounces delivered. This is not investors buying monster boxes. This is not preppers buying 10-ounce bars. This is someone with capital reserves measured in billions. Someone who knows the game board. Someone preparing for a world where supply is uncertain, where geopolitics override financial engineering, where strategic materials become leverage. And make no mistake, silver is now strategic. The US just officially designated it a critical mineral. When the US government labels a commodity critical, that is not for fun. That is not ceremonial. That is preparation. And what's the very next thing they propose? A government-sponsored price floor under critical minerals, including silver, to incentivize domestic mining. Why? Because the real all-in sustaining cost of new silver production is nowhere near $20 or $30. If you want fresh supply in a declining grade environment, with most silver coming as a byproduct, then you need pricing closer to $40, $50, maybe even $70 to justify new exploration and production. Meanwhile, China, the world's largest refiner, tightens export controls. Only 44 companies allowed to export silver. Even those face delays, bottlenecks, licensing hurdles. This is China turning off the faucet. Not completely, not yet, but enough to create strategic scarcity and send a message. We will prioritize domestic needs first. This has enormous implications. Because 70% of the world's doré silver flows through Chinese refineries. If China wants to keep more of it, refine more of it, and export less of it, the West has no choice but to either outbid everyone or scramble to rebuild a refining infrastructure it allowed to atrophy decades ago. And while all of this is happening, the paper markets are breaking down. Backwardation has become constant, which is unheard of for silver. Lease rates have exploded from 0.25% to 8% or 9%. That is the market screaming, "We don't have enough metal to meet obligations." Backwardation means, "Do not promise me silver next month. I want it right now." That type of market structure only shows up when trust breaks. If this were 2011, raising margins would have crushed the rally. Back then, traders were leveraged and speculative. They got kneecapped by margin hikes. Today, they raise margins 30% the day after Christmas, twice in December. And not only does silver not crash, but delivery spikes to the highest level in COMEX history. That's because the buyers now aren't hedge funds using 5-to-1 leverage. They're entities buying for possession. Margin hikes aren't a deterrent, they're a subsidy. Oh, you want to raise margins? Great, that shakes out speculators and lets me buy real metal cheaper. Fantastic. Load the truck. But let me explain something most people don't see. Refiners are choking. They can't take new business. Not because they don't want to, but because hedging is becoming unaffordable. If you have $30 million in work in progress, you must hedge that amount on COMEX to stay market neutral. And if the hedge requires $40,000 in margin per 5,000-ounce contract, you're talking millions and millions of dollars sitting in margin accounts, money you don't get to use.